Right now, there is a massive, breaking contradiction unfolding in global finance, and if you're an investor, you absolutely need to be paying attention. Just a short time ago, headline news declared that Russia officially legalized cryptocurrency. Now, if you just read those headlines, you'd probably think, wow, a major global power is suddenly embracing Bitcoin. But as we're going to see in this explainer, the reality is much more complex, it's heavily restricted, and it holds some really major implications for your own portfolio. So let's just dive right in and uncover the real macroeconomic chess match happening right under our noses.
Here is what actually happened. On August 4th, Vladimir Putin signed a sweeping 287-page law. Officially, it's called the Federal Law on Digital Currencies and Digital Rights. And yes, this legislation does technically legalize crypto for foreign trade, but here's the massive catch that the headlines missed. Everyday Russian citizens, who the law conveniently classifies as non-qualified investors, they are strictly capped at buying just 300,000 rubles worth of cryptocurrency a year. To put that into perspective, that translates to a measly $3,700 a year.
So that begs a pretty obvious question, right? Why go through all the trouble of legalizing cryptocurrency, which is natively a borderless, decentralized asset, only to instantly slap immense restrictions on your own people? Well, we're going to peel back the layers of this legislation, moving way past the official government line, to really understand the true financial warfare playing out globally. Let's start with Layer 1, the official story of evading sanctions and reclaiming trade. The surface-level motive here is entirely about foreign trade. Since being cut off from the Western financial system back in 2022, Russia has faced immense friction trying to get paid for its exports. We're talking oil, gas, precious metals. So, the official narrative is that this crypto legislation is simply a practical tool to bypass those sanctions and reclaim their spot in global trade. It's really interesting to see how Russian leadership is actively framing this. Take Vladimir Putin's own statement. They are portraying this move as a purely defensive mechanism. The argument they're making is that any nation could suddenly wake up and find themselves blocked from dollar or euro reserves, just based on geopolitical pressures. So, they argue that creating a legal crypto framework is simply a way to protect their sovereign wealth from what they view as unfair competition and external control.
Now, to truly grasp this, we need to quickly look at the mechanics of global money movement. The absolute choke point here is something called a correspondent account. When a company in one country buys something from another, the money doesn't just magically teleport, it hops through a chain of intermediary banks. And because the US dollar is so dominant, most of those chains eventually pass through a US institution. Basically, whoever controls that correspondent account controls the switch to either allow or completely block international trade. It's actually pretty ironic. A sovereign nation's entire ability to trade globally often relies completely on a middleman bank sitting in New York. And in 2022, Russia lost access to a lot of those vital connection points.
Now, you might be thinking, why not just use shadow banking or informal networks? Well, the US Treasury is aggressively hunting down and cutting off those exact networks. Just recently, the Treasury severely cracked down on entities moving hundreds of millions of dollars on behalf of an Iranian bank. They made it explicitly clear, anyone facilitating these shadow systems will be completely cut off from the US financial system. So because of this intense mounting pressure, Russia is essentially being forced to build a formal legal crypto pathway to settle trades. They need a bearer asset, something that goes wallet to wallet, so they can completely remove the US correspondent bank from the middle of the transaction.
But here is exactly where that official story falls apart. If this is truly just about foreign trade, why aggressively target the everyday citizen? Not only are ordinary Russians capped at that $3,700 a year, but they also have to pass an undefined regulatory test just to get permission to buy it. On top of that, they can only purchase digital assets from a pre-approved government list, which, by the way, doesn't even exist yet. And the real kicker? The strict ban on actually spending cryptocurrency for goods and services inside Russia remains entirely in place. This is a glaring contradiction, and it requires us to weigh the official theory against the unofficial theory. While the official idea of evading sanctions totally explains the corporate side of things, it completely fails to explain the domestic restrictions. The unofficial theory, however, bridges that gap perfectly. It strongly suggests that Russia isn't actually embracing Bitcoin at all. Instead, they are desperately trying to prevent massive capital flight from their country using central bank digital currencies. And that brings us to Layer 2, the real motive, which we're calling the stablecoin tsunami threat. Look, to understand where the global macro puck is going, you have to look at what governments are genuinely terrified of. And right now, they are absolutely terrified of digital dollars.
The true macroeconomic threat keeping them up at night is the stablecoin. Think about it. A stablecoin effectively gives anyone with a smartphone and an internet connection direct, unfiltered access to a digital US dollar that's backed by US treasuries. For the last 80 years, governments could easily enforce capital controls just by locking down physical banks. But stablecoins? They bypass traditional banking infrastructure entirely. This is a literal nightmare scenario for any government that's trying to manage a depreciating local currency.
And believe me, Russian officials are acutely aware of this. Anton Kobiakov, a presidential advisor, actually described this incoming crypto cloud of digital dollars as, quote, something that no border could ever stop, no army that could ever defend against it. The Russian government knows full well that if given the unrestricted chance, 140 million Russian citizens who have watched the ruble lose value their entire lives would eagerly drain their local savings and instantly convert them into digital US dollars.
Which naturally leads us to layer 3, building the digital wall and centralizing the future of money. Because how do you stop a borderless technology from draining your nation's wealth? You can't just turn off the internet. So, instead, you build a digital wall. You front-run the decentralized technology by forcing your population onto a highly centralized, strictly monitored alternative before those decentralized options can ever take root.
We really need to draw a stark contrast here to expose the Trojan horse we're witnessing. On one side, you have true cryptocurrency, like Bitcoin. It's decentralized, it's permissionless, and it is highly resistant to state control or tracking. But on the flip side, you have what Russia is actually pushing, the digital ruble. This is a central bank digital currency, or a CBDC. It is entirely centralized, issued directly by the Bank of Russia, and exists on a ledger where literally every single transaction is visible to and controlled by the central bank. They are fundamentally opposite things.
And the smoking gun in all of this, it's the timing. It is absolutely no coincidence that Putin's heavily restricted crypto law went into effect on the exact same day that the digital ruble officially launched, September 1st. On that very day, 12 systemically important Russian banks and all businesses with over 120 million rubles in revenue were legally mandated to begin utilizing the central bank-controlled system. And if you look at their timeline, this net is going to progressively widen over the next few years until it legally captures all businesses.
Now, get a load of this data point, because it's pretty staggering. According to state polling in Russia, despite this massive governmental push, only about 10% of Russian citizens are actually willing to accept their salary in this new digital ruble. A massive 90% are unwilling. People don't want a third form of heavily monitored money. But the rollout is being aggressively pushed forward anyway, which just proves that this isn't about consumer demand at all. It's about state control and trapping capital.
Okay, so what does this all mean for the resolution? Let's talk about the takeaways for everyday investors, because we need to break down exactly how this global shift in digital money impacts your own portfolio.
As an investor looking to protect and grow your wealth, you've got some clear, actionable takeaways here. First off, you need to realize that geopolitics, not just retail hype, is heavily dictating the massive institutional adoption of digital assets right now. Second, you absolutely must differentiate between centralized CBDCs, which are essentially instruments of surveillance, and true decentralized cryptocurrencies. Third, don't ignore the monumental, borderless global demand for digital US dollars. When banking systems weaponize access, that demand skyrockets. And finally, you have to consider how the rise of these strict digital capital controls might negatively impact the long-term value of isolated fiat currencies.
This whole situation leaves us with one final, really profound question to chew on. As global powers race to build these restrictive digital walls, will decentralized, borderless assets ultimately break through and empower the individual? Or will governments successfully trap their citizens' wealth behind centralized digital borders? It's a question that is, without a doubt, going to define the next decade of investing. Thanks so much for joining me for this explainer. Keep your eyes open out there,